Every company talks about the importance of innovation, and investment in innovation continues to grow. However, many companies are finding that the time and money invested is not giving them the payback that they had hoped for. But is it possible to structure your initiatives so that you can drive better return on investment? And if so, what would that look like? I'm Jane Singer, and thank you for joining me here today. It's wonderful to have you as part of our international community that includes top-performing executives like you from over 100 countries. It's great to know that so many people around the world are able to benefit from the experience, insights, and wisdom of the many truly outstanding people who are guests on this show. And in case you haven't heard, you can now ask our guest questions. You can do this by simply going to our website at seatpodcast.com. That's SEAT podcast.com. And there's a form where you can submit a question. We'll forward it to the guest, and we will send their answer to you. Today, I'm talking with Dan Toma, an innovation strategist and author of Innovation Accounting, a practical guide for measuring your innovation ecosystem's performance. The book focuses on why a one-size-fits-all approach for measuring an organization's innovation investments does not work, and how and why the use of modern and comprehensive innovation accounting systems to measure and track innovation is needed for success. In this episode, Dan will talk about 4 types of innovation and how they help define what innovation means for your company. 9 pitfalls venture boards are avoiding to create better outcomes. How to quantify innovation and measure a company's innovation ecosystem's performance, and 5 stages to develop the best product development framework for your company. Before we get started, if you are a supply chain executive who would like to finally put an end to information overload and get a simple, concise, fact-based summary of key market developments and shifts, then the current situation in sourcing is exactly what you're looking for. To get immediate access, head on over to thecurrentsituation.net. That's thecurrentsituation.net, where you can get all of the details. I'll also put a link in the show notes for this episode, and of course the information will be over on our website. Okay, let's find out from Dan how we can get better results from our investment in innovation. Dan, I'm very excited to have you on the show. I think that what you're talking about with regard to innovation is such a big topic for companies these days because everyone's really being challenged to innovate, right? There's so much pressure on companies. Come up with something new. Be innovative. You see all the tech startups, right? They're getting all the attention. They're getting massive valuations. And a lot of companies are really, sort of confused as to what to do. And a lot of people said we're pouring a lot of money into things. We're not getting the return on investment that we hoped for. So I think it's interesting to be able to talk with you and learn from some of your experience. Talked about 4 types of innovation and how they help define what innovation means for your particular company. Can you walk us through what these are?
First of all, thank you very much for having me on the show. With respect to innovation, it's very important for companies to define what innovation means for them, because starting from that definition, they will start taking some steps towards making that happen. Not all innovations are made equal, and this is why there are many types. And depending on what is going to work for you or what you need for your company, then you might invest in certain things and you might divest from other things. Here I'm talking about talent, I'm talking about a certain system you want to build, and even the indicators you want to put in place. Some types of innovations are measured with some indicators, others are measured with other forms of indicators. Now, in terms of the types, you can think of it, and I'm going to use here a framework that was actually put forward by a good friend of mine, Greg Suttel. And using that because it seems to be very logical and people seem to react very well to that. First of all, you have basic research. That's a form of innovation in itself, where you're just going to research, a new compound, a new technology, a new composite material, whatever it is. But that's basic research. Now, in terms of the other types of innovation, we're looking at disruptive innovation, and that's actually the one that you just mentioned about. The ones that the startups that get the most valuations are probably doing the disruptive side. But there's also evolutionary and revolutionary. So evolutionary to some extent means that we are just doing incremental improvements of old things that we have done. Think of it, I don't know, in terms of the automotive industry. We just came up with a combustion engine that is going to consume less fuel. Or we've put in whatever integration with whatever software platform in the car. That's an evolutionary innovation. And then you have revolutionary innovation, which is more towards taking what we already know, but totally turning it on its head. In the car industry, again, I'm going to use that because that's something that people can easily relate to. We're talking here about EVs. EVs are a revolutionary innovation in the automotive space. Indeed, with time passing, we see a commodization of certain features. We see a commodization of certain technologies. Essentially, what we thought was super innovative 5 years ago or 10 years ago, we are starting to expect or take for granted in the products that we buy today. Right. And that forces organizations to think differently about innovation, try to find, and obviously it forces organizations to invest constantly in innovation because with time passing, things become commodity. So they have to invent the new things and push the boundaries further.
Yeah, I think that's definitely one of the big challenges that companies face, and probably not easy to try to determine which is the better direction to go. Do you do something that's revolutionary, or do you just try to improve upon what you have? I mean, people tend to want to do the next big thing, kind of a bright, shiny object, whatever's going to be making headlines. Is that the most practical way to go? Or do you think companies might be overlooking opportunities in just taking what they already have and just trying to make that better?
There's a couple of things we can discuss here about. First of all, I think every organization or any organization in the world should look at what exactly makes them go to innovation, what drives them to invest in innovation, right? And then from there, they can decide what kind of innovation they need. On the other hand, I don't recommend any organization to just do one type and one type alone. You have to essentially play this game like a venture capital investor would typically do. You have bets, and these bets vary in nature. Some of them are riskier. We're talking here about the disruption side. Some of them are less risky, more the incremental side. So you need to have a spectrum of investments if you want in innovation, rather than just saying we're going to go all in on disruptive or all in incremental, and we're going to ignore everything that is disruptive. All the organizations in the world need to have this, array of investments that they are making.
Interesting. I think that typically you do look at it as being an either-or situation. So I like the fact that you brought up that you really need to have a spectrum of innovation, not just think that it's either doing something disruptive or simply improving the product. So you need to look at innovation as sort of a multi-dimensional or multi-project kind of a part of your business.
Indeed, if you just let's say hypothetically we have an organization that only invests in disruptive, what's going to happen with them is that they will get disappointed very fast by the idea of innovation or investing in innovation. Why? Because disruptive by nature is high risk, high reward. But again, the emphasis here is on high risk. So probably more than 80% of their investments will not come to fruition. Most of their investments will be just money thrown out the window. On the other hand, if we consider an organization that only invests in incremental, they will probably be disrupted very fast. And, history is full of examples like this, from Kodak in the 80s that was totally disrupted by Fuji, right? Because what they were doing, they were only investing in making the camera, the film camera better and the films better, with basically toll on the disruptive innovation. They were not investing at all in digital. They were not investing in any way in anything that was beyond film. So that took a toll on the organization. Or competitors of Netflix, right? Like we all know the blockbuster story, how they went bankrupt. Why? Because they were only investing in incremental, ignoring totally disruptive. So again, for anyone that's listening, I would encourage you to do the entire array of innovation, not just one.
Yeah, I think that's a really good point. You had talked about there are 9 pitfalls that venture boards are avoiding to create better outcomes. And I think that in and of itself is interesting because we just think that there is so much appetite for venture capital, particularly flowing into anything innovative. And if it's tech, even more so. Can you talk about that a little bit? I mean, what are they trying to avoid and what are they looking for?
Sure. The venture board concept essentially is a concept that's imported from the VC world, as you just very well mentioned. Essentially, within a large organization, we try to replicate the same mechanism that venture capital investors have. Basically, they invest in certain ventures within the organization and then they follow up with them. Now, through our experience, we've noticed some patterns, if you want, and some patterns that usually lead to people getting very disappointed in the results that the innovation investment is bringing. These particular patterns usually revolve around the way that the venture boards are conducting themselves when operating within the corporate environment. So we've seen things like the meetings, like the check-ins with the teams being very sporadic, not meeting with a set frequency. You know, any startup founder will tell you that they have meetings set up with their investors for the next 3 years. They know exactly what's going to happen when they're going to check in with their investors in 2024. We don't see that in some cases in corporations. They just meet whenever the team is ready or whenever there is pressure or whenever there's some news, right? That's definitely one of the things that we have seen. Other things that we have seen is that usually the meetings get hijacked. Basically, they become a beauty pageant. Everybody's going there to show how cool their idea is and use the coolest presentation. And sometimes they spend weeks on working on the presentation instead of just focusing specifically on what they have done in the past, I don't know, iteration, what they've learned and what they want to do next. Here, we encourage venture boards and teams as well to agree on some predefined templates and script and only stick to those. Again, this is not news. This is not something that we have invented. This is something that the venture capital investors have been using with their portfolio of companies for decades, if you want. They go into these meetings with very clear guidelines on what the meeting should be and not going there for a pitching contest. The pitching is over the moment you get the financing.
Right. Yeah.
Once you are past that line, you start showing that you are making progress. And the same way venture boards should behave within the organization.
Yeah, I think that's really a very good point to bring up because you're right. Within an organization, you do tend to be less strict because it's not outside investment necessarily. So, and they're people that you already know and have as part of your team. So it becomes a little bit different. Are there other pitfalls that companies need to be thinking about?
Well, we can think of no decisions being taken. This is a very important. This is a very important one. People believe that once they got the financing from their boss, from their manager, from the head of the innovation lab, from the director of innovation, whatever title that person has, it's all smooth sailing from there. They don't have to worry about anything. They just need to stick to the roadmap and deliver against that. Actually, reality is that at every point, a decision needs to be taken. Every meeting that the teams have with the venture board, there needs to be a decision that needs to be taken. And that particular decision can be either persevere, meaning guys, continue, you're on the right track, you've learned a lot, it makes sense for us to continue investing in you, time and material and other resources. It can be a stop decision. There is no evidence in the market, guys. You've been trying this for 3 months now. And there is absolutely no evidence. Let's just cut it short here. And you can go back and come up with another idea, use that learning, but let's stop this idea here or pivot. Again, a very important decision that needs to be taken. Guys, you're obviously there is something here, but not in the direction in which you are going. So maybe it makes sense to look at another channel or look at another customer segment or look at another value proposition. All the pivots that you can do. So taking one of these three decisions is very important. And this decision need to be communicated to the teams on every check-in. Otherwise, you run the risk of the entire infrastructure, the venture board. No, I'm talking here about the venture board infrastructure not being taken serious by either the teams nor the members of the venture board. You need to make this real. People need to understand that at any point, any decision of the three mentioned above can be taken and will be taken.
Right.
I've seen organizations that just let things go and continue
Right.
and continue without any decision being taken, in spite of evidence that, yes, we should be taking a decision, persevere, or stop, or pivot.
We're going to take a quick break now, and then we'll be right back.
We were hiring when we were making 50 to 100K monthly losses.
And why? Welcome to episode 1.
I can't think of a single founder who's been around for a decent amount of time in business who hasn't had their tunnel of year. This was that year. We're going to be okay, yeah, Sheree. Some are going to hear this and think, you TDP. But hear me out. You only have to do the math to understand that very soon we were $500,000 down.
So do you think this is somewhat along the lines of that fail fast kind of a mindset that says, give it a try, and if it doesn't work, get out?
Obviously, it helps with that. It's part of operationalizing that mindset. Because to be honest with you, and I've been a startup founder, and I'm sure that some of your listeners have always been in that role. It's very difficult to kill your own baby.
Right.
You've been dreaming about that idea for years. You've been ideating, probably you've been working on it for years. And it's very difficult for you to kill your own baby. But it's so much easier when somebody else does it for you, or at least convinces you that, hey, this is not necessarily a good idea. This is not necessarily a good path to go down on. So the venture board system is there to help people get out of their biases and get out of their love relationship with their own ideas.
I think that's a really good point. And I think that we're all guilty to some degree or another, me too, of, like you say, falling in love with your own idea or your own project and staying with it past its expiration date, so to speak. You talked about what venture boards are trying to avoid. Are there things they're looking for in particular, things that you think stand out?
Usually they try to maximize the efficiency of their innovation investment, while constantly de-risking the ventures that they have in their portfolio. So essentially, they try to get more for every dollar that's being invested in innovation. And I think that this works across the board. I've seen it being the goal of venture boards in healthcare as much as I've seen it being the goal of venture boards in banking.
Okay. Yeah, I think that when I look at a lot of the different companies out there who are all, trying to navigate a very uncertain environment, very complex, certainly as things get increasingly global, as so many different factors come into play, it's not that easy to try to figure out what might be the next thing that you need to focus on, how to manage so many things that are constantly changing. A lot of companies seem to get stuck, as you're saying, when they try to benchmark some of their innovation. How do you quantify innovation and measure a company's innovation ecosystem performance? You were talking about you have to know when to fold up your tent and go home, but how do you benchmark it?
Very good question. Actually, we wrote a book about the topic because this is something that even though it sounds easy as a question, right, very straightforward, it actually required a lot of research trying to answer it.
I'm sure.
First of all, I would say that one of the mistakes we've seen a lot of people make whenever they have this question, and a lot of leaders have this question, is that they try to find that one single indicator. to measure innovation, right?
Okay, yeah.
We mentioned in the innovation accounting book that this is not Lord of the Rings, guys. This is not
Right.
one ring to rule them all. You should not try to find an indicator to rule them all. It's an array of indicators that you can use and you can put in place in order to measure the efficiency and effectiveness, if you want, of your innovation ecosystem. Some things obviously stand out, like, for example, the new product vitality index. This is an indicator I really like. That's basically defined as percentage of revenue coming in this year from ideas that we launched in the past 3 years.
Okay.
So this is telling us exactly how much are we making today from the ideas that we've invested in over the past 3 years. And very much connected to the NPVI is an indicator that I call AII. And AII stands for the efficiency of the investment in innovation, or efficiency of innovation investment. This basically is defined as from that revenue that we generated from the products that we launched in the past 3 years, how much have we invested? It's basically a ratio.
Okay,
For
yeah.
every $1 of new revenue, how many dollars of innovation expenditure are associated to that? So these two really work nicely together. One is telling you how much money you're generating. The other one is telling you how much money you've spent to generate that particular amount. Also, you have portfolio distribution. So now it goes back to your first question, talking about types of innovation. Portfolio distribution is essentially telling you what type of innovation you're investing in, what's the distribution across your entire investment portfolio. Again, it's telling you, are we just doing incremental, where we're doing a mix of incremental with disruptive? And obviously, there are more indicators, but these will be the ones that will definitely stand out.
I like the way you've put that as indicators, and that you need multiple indicators, because I think you're right. I think people have a lot of trouble benchmarking things, and oftentimes you do look at the wrong indicators, or sometimes you're looking at immediate indicators where the benefit might be over a longer period of time. So I like the fact that you're looking at what you did 3 years ago that's impacting today. So you're giving yourself somewhat of a timeline, a fair opportunity to see a return on investment. And at the same time, you do have a bit of a speed bump, so that if you're still not seeing any return on things, you know that maybe that thing is never going to go anywhere.
Indeed. And, it's unfortunately, it's in human nature that we're trying to game indicators. And we started doing this since first grade in school. We've been trying to game the system to get a better grade.
So true.
It's in our humor, right? And everybody did it, right? And the people that are saying that they haven't, they're probably lying. And we kind of like that with us in the corporate environment. If we're just going to measure innovation against one single indicator, we're going to see some people trying to game it just because they want to look good in front of their peers or in front of their boss, or they might have other reasons. They just might be an over accomplisher and they want to, have the best results in the department or in the unit or in the company. For example, just to make the conversation a bit more concrete for folks, take, for example, NPVI, right? New Product Vitality Index, percentage of revenue that we generated today from the things that we've done 3 years ago. Well, if we just measure innovation against that, what we are going to see as a behavior, and this has been actually documented with major chemical companies in the US. I'm not going to name names here. But what they were actually seeing is that a lot of the leaders that were in charge of innovation within that company were investing solely on incremental, because incremental innovation was very easy to do. And in 3 years' time, they will have really good numbers to report because, yes, you see, I'm generating revenue from investments that I've done 3 years ago. And they had less appetite for risk. They had less appetite for disruptive innovation because that's riskier. Yeah. Things might fall through. Things might not fall through. We don't know. Let's just keep it to incremental, and I'm making my targets in 3 years' time.
Yeah.
Again, this is one of the pitfalls of just using one single indicator to measure innovation.
It's a good point that you bring up, and you're absolutely right. I mean, you can't help the fact that when you're in a company and you want to hold on to your job and you need to meet certain targets, you will be inclined to do something that offers you the most reward for the least amount of risk, even if long term that might not actually be ideal. But how do you then, as leadership in a corporation, find a way to, on the one hand, of course, you have to be thinking about making shorter term goals, but how do you reward people and encourage them for going for those longer term, perhaps higher risk directions and projects?
First of all, I would, and this is an advice I'm giving to leaders that we work with. First of all, I will try to decouple incentives from indicators.
Interesting.
Because once you put an incentive, once you associate an incentive to an indicator, or vice versa, you are going to see a lot of people try to game the system we just talked about, right?
Yes.
People will try to get that A or try to get that 10 grade, right?
Absolutely.
They'll try to get 100% because there's an incentive connected to it. So first of all, I would remove that first. That will be the first action. Second, invest a lot in education and invest a lot in culture. Create a culture that supports radical innovation. Create a culture that rewards, in a non-financial matter, if you want, radical innovation. Organize events, put people on stage. Hey, this is Jody, and she's done an amazing work over the past year, investing a lot in disruptive or taking a lot of risk, and look how much we have learned. Incentivize learning over financial results, because learning is a segue to financial results.
So
However,
true.
it's a segue that's not being incentivized in the majority of companies, or at least the ones we have worked with. Incentivize learning, incentivize people, doing smart mistakes, because smart mistakes means that you're actually learning something, means that you have approached that certain project in a way in which, yes, it didn't work out for the project, but you've learned so much, and through that learning, you can do better, and your peers can do better. This will be the top 3-4 things I would recommend leaders do. Obviously, every organization is different and every corporate culture is different. So try to match your actions to the environment for which you're taking those actions.
I think these are really good points, Dan, and I'm very glad you brought them up, because it is difficult, even for very senior leadership, to get caught up focusing on immediate results. We all need to make sales targets, profitability targets. I mean, business is business. We can't deny that. Very few people have these massive budgets for innovation and very, very long timelines. Amazon has a certain opportunity, and perhaps Elon Musk and his companies do, that most of us are not working in those environments, and yet we still need to be innovative. So I'm very happy that you pointed some of these things out, that companies can look at it from a different point of view, and sort of a mid-ground for what a company that isn't an Amazon or a Tesla could do. I think that's very important.
Yeah, most of the companies we work with are not the Teslas, are not the Amazons. They don't have the luxury of being the darling of the stock exchange. On the contrary,
Right.
Every mistake that they make is going to be heavily sanctioned by the Wall Street
Right.
analysts and by the investors, even if it is missing a quarter's forecast, right? Not even talking about a year's forecast.
Right, absolutely.
But there are actions you can take, and there are ways in which you can bring investors to your side. Talking about culture, Zappos in the US is known for an amazing customer-centric culture.
Yes.
Try to mimic that. Again, there are more organizations that come to mind. Spotify, again, in Sweden, amazing organization that is incentivizing people to learn and take risk. But again, these are digital native organizations, if you want, organizations that were born in this century or at the end of the last century. We're not talking about organizations that are 150 years old. But even in that batch of organizations that are 100 plus years old, there are some front runners, if you want, and names like 3M or DuPont or Telefonica come to mind when we talk about those type of organizations.
Right. Now, you mentioned there are 5 stages to develop the best product development framework for a company. Can you talk a little bit about that?
Sure. We typically refer to the product development framework or the product lifecycle as the backbone of any innovation accounting system. So essentially, if you want to measure innovation and you don't have a product lifecycle in place in your organization, you won't be able to measure it. Going back to your first question, the types of innovation, is very important to have that product lifecycle, have that process in sync with the type of innovation. And by in sync means that the questions that you are asking are relevant for the type of innovation you are going to have, or the type of ideas that you are going to see going through the funnel. Another important step is to bring as many people as possible on board with the idea of having a framework in place in the organization. And I'm not talking here about, a 100% inclusive culture or anything like that. I'm just talking about getting perspective and getting representation. Getting perspective from the people that are going to put it in practice, to the people that are going to use it on an everyday basis, to the people that will have to at one point finance those ideas that pass through it. So everybody needs to chip in on what that product lifecycle will look like. Obviously, it's very important that you define success criteria for every single stage of the life cycle, and those success criteria need to be obviously in sync, as I said, with the type of innovation that you're doing, but also with the business models that you are going to see, or the ones that you desire to see in your organization. So this would be the 3-4 things that you'll have to keep an eye out for once you start developing. But it's very important to remember here 2 things. First of all, you can't measure innovation if you don't have that in place. That's very important. And second of all, the questions need to reflect the maturity of the ideas. Innovation accounting and measuring innovation and managing innovation is about asking the right question at the right time.
Absolutely.
And that means essentially don't ask things that are designed or make sense or are relevant for mature ideas to an idea that was just created yesterday. And that's the purpose of the product lifecycle, to prevent that from happening.
It's an important point. And I also like the fact that you brought up the importance of asking questions of multiple users and developers and many different departments, but also including your customers, because so often things are developed in a silo, or even if they ask multiple departments, but very, very rarely do we see a real outreach to the end user and asking people, would this be useful to you? And you see innovation coming out, that it's innovation for the sake of innovation, right? And that nobody at the consumer level, whether that consumer could be an individual or it could be a corporate consumer, but customer level, I suppose I should say, you don't see anybody asking the customer, is this useful to you? Does this solve a problem for you? So I'm very glad you brought that up.
Yeah, that needs to be embedded at every stage of development of the idea. Organizations should try to be customer-centric beyond logos and mottos on PowerPoint presentations.
So, yeah, absolutely. That's very true. Yeah. Well, Dan, you've shared so many interesting things. How can people connect with you? I'm sure a lot of people would love to read your book. Tell us where we can find you.
Thank you very much. I'm pretty active on social media, so LinkedIn is my drug, if you want.
Yeah.
Twitter as well. So you just go on LinkedIn and look for me, Dan Toma. I'll probably pop up in the first answers there. Also on Twitter, the handle is Dento_MA.
Okay.
Dan Toma was taken.
Right.
That's why I had to put an underline. But also there are some websites for our books for innovation accounting. You can find more about the book, and we also have a blog there discussing how to measure innovation. And you can find everything under innovationaccountingbook.com. And if you're interested in general about the topic of corporate innovation, you can find more about our first book, The Corporate Startup, under the corporatestartupbook.com.
Wonderful. Well, I'll also include those in the show notes, and they'll be over on our website for the podcast, seatpodcast.com. So I think a lot of people want to reach out to you. And thank you so much for being here with us today.
Thank you very much for having me, Jamie.
Thank you for tuning in to A Seat at the Table. If you enjoyed this episode or learned something from it, I'd love to hear about it. Your feedback powers this show. If you'd like to support the show, please hit the subscribe button so you never miss an episode. Also, share episodes you found valuable on LinkedIn or other social media, and call out your biggest insight or takeaway from the program. And don't forget to tag me, Jane Singer. I'd love to see which episodes you like best. And if you have time, please leave a review on any of the major podcast channels. As I mentioned at the beginning of this podcast, A Seat at the Table has a new feature. If you've ever listened to a podcast and thought, I have a question, well, now you can ask. I'll be letting you know about upcoming guests on our show, and you can send in questions. Also, you can ask questions after the show, and we'll forward them to our guests for feedback. If you'd like to participate or just want to learn more, head on over to our website at seatpodcast.com. That's SEAT podcast.com for all of the details. The links will also be in the show notes. You can leave any thoughts, feedback, or suggestions there, and yes, I will read them. Thank you for joining me today and for supporting the show. I'm Jane Singer, and I'll see you in the next episode of A Seat at the Table.